Ladies and gentlemen, may I kindly ask you to be seated so our panel can proceed? Thank you very much for your attention. Ladies and gentlemen, the new panel is chaired by Joachim von Schorlemer, and the floor is yours. You will introduce your kind panelists. Thank you very much.
Thank you very much. Dear ladies and gentlemen, welcome cordially to our panel on banking and supervisory. The enthusiastic welcome of the recent issue of the Greek government bond by the financial market suggested that the crisis is over. Hence, the question is, of course, why discussing again the need for an institutional framework of state bankruptcy? We have very distinguished panelists coming up here. This makes me certain that our discussion will be as inspiring as the topics you already discussed this morning. I'm very honored and pleased to chair this discussion. My name is Joachim von Schorlemer, as you kindly introduced me, and I am heading the wholesale banking of the Royal Bank of Scotland in Germany, Austria, and Switzerland. I would like to introduce the panelists by the order of travel distance. And I start with Carlos Thadeu de Freitas Gomes. And as you probably have seen, he currently is the chief economist of the National Confederation of Commerce, Service and Tourism. And of course, as we all know, former member of the board and director of the Central Bank of Brazil. And as he told me, has been very often to Frankfurt, already days before the introduction of the ECB at Bundesbank times. Professor Kamil Janáček. Professor Janáček is a member of the board of the Czech National Bank. Welcome. And, well, Professor Franke, you have then further distance than Dr. Meyer. Professor Franke is heading the chair of international finance at the University of Konstanz. And Dr. Thomas Meyer, also, of course, a very familiar face here in Frankfurt, has worked for many years for Deutsche Bank and is senior economic advisor of Deutsche Bank AG. Ladies and gentlemen, we have 45 minutes, and hence I would like to give a bit of housekeeping rules. Please stay focused and to the point. Hence, we can cover more of the aspects we would like to discover and discuss. In case we should get in trouble in terms of time, then you will hear from me. Our panel discussion today will break into 3 parts. The first part will serve as a common ground and understanding of the challenges we face. We will first have a first round on the question whether we think the crisis is over. The second section will cover then the focus on sovereign debt and the possibility of state bankruptcy in the Eurozone. Do we need a default mechanism for this case? And finally, how can we tackle the issue of the still existing nexus between banks and states? And finally, the third complex of our discussion will circle around ECB's policies and strategies in dealing with EU member states' debt. Obviously, the audience shall take part, so we will have time for questions from the audience before finalizing with a roundup at the end. The wrap-up will cover 2 aspects, which we then always will hear not all 4 panelists, but 2 each on the question, what lessons can be drawn from experience on the American continent in the past decades? We've guessed probably whom I will ask. And what is going to happen next? We'll see. The part 1, status quo of the crisis. Let's get started with a clear yes or no by each of you on the following question, and then Professor Janáček has the opportunity to give his entry statement. Question number 1, is the European debt crisis over?
No.
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 Ladies and gentlemen, that is a clear and good first agreement. Professor Janáček,
Yeah.
please.
I will be very short and so only my thesis. The crisis is not over for me for following 7 reasons. The recovery in many Eurozone countries is very weak, uneven, and in general, European economic growth is anemic comparing to other parts of the world. And without more robust growth, we would be unable in a short run to solve fundamentally the crisis in the financial sector. Second, the vicious nexus between sovereign debt and balance sheet of majority European banks continues. In the last 6 years, the share of sovereign bonds in the books of European Eurozone banks increased more than 12-fold. Situation is aggravated by fragmentation of the European financial markets in the post-Lehman period. Fourth, despite the improvement in the books of many banks, in some banks the problem of governance was not solved. Being from the central bank, I must abstain, let's say, to name the banks or the states. SSM and CRM are only a part of the solution. I would like to quote only some data. Assets, I am now, being from the non-Eurozone country, I am now quoting the official data of Eurozone countries, asset of the banks, 30 trillion euros, investment of banks in government bonds, 1.7 trillion out of 9 trillions of government bonds of Eurozone countries. CRM, 0.06 trillion, and if we add European system mechanism, is another 0.06 trillion. State debt is 9 trillion of euros. It's 95% of GDP. And according to the last figure from Fitch, bad debts, bad loans in the books of 100 biggest Eurozone banks under asset quality review is 1 trillion euros. 6, little confidence of US financial markets about the quality of assets of some European banks, and not only US financial markets, but some other markets. And 7, of course, you can tell me the asset quality review and stress test are here for improving the situation. AQR must bring, it is under 2 conditions. Asset quality review must bring favorable results. Only small or medium-sized mistakes will be found. And second, the stress test this time must be credible. Results must be bulletproof. Unlike in the last round of stress test. Last round of stress test was really a disaster for European banking. I stop here, Chairman.
Professor Janáček, gentlemen, bulletproof is a good term. As you all agreed that the crisis is not over, the question to you, very short and precise again, were the past 5 years fruitless of everything which has been done?
Me?
Please.
No, I don't think everything has been done. It takes time. It takes a long time. In Latin America, it took us 2 decades, 2 lost decades to solve our debt problems. And here in Europe, I think things are not so easy at all, because it's very complicated, because of the bank situation, because of the economic growth that's not so high in many countries here, because of the unemployment rates that are so high. And here it's quite different from Latin America. In Latin America, we had to bear our sacrifice alone. We made a lot of mistakes, obvious. We overconsumption, we overborrowed abroad, but we corrected our mistakes alone. Here in Europe, some member countries can shift the problem to other countries. That's the problem here.
Professor Franke,
well,
continue to pile up debt, right?
Yeah, I think Professor Janáček very clearly mentions the problems in the banking sector. He didn't say very much about the governance of the states. And I think we see in quite a few states that the debt GDP ratio still increases. And I think The structural reforms have not been set in place in many of the countries, and also we need to find a new balance between austerity and structural reforms, which may induce some Keynesian economics, but which at the end improve the basic running of the economy, and that is still missing in many countries.
Finally, Dr. Meyer.
Yeah, I said the crisis is not over. But I think one can say it has mutated. The immediate crisis in the financial markets is gone when you look at the spreads. And in pursuit of the reason why it's gone, I was recently in a southern European country and I asked a member of the government, are you not worried about what you, Professor Franke, said, your relentless increase in the debt ratio? Would that not come back and haunt you in the end? And he said, not at all. We have Japanized our debt. So I learned a new word. Japanization of the debt basically means you have a backstop. If the market doesn't want to buy it anymore, there's someone there who buys it. If not the ESM, because it's not big enough, it's going to be the ECB. That's Japanization of the debt, which has helped the spreads to come down. But I feel that the Japanization goes further than that. We also have a Japanization of the real economy, and we have a Japanization of the inflation outlook and eventually political instability. So the risks have moved to the real economy and the political side.
That brings us to the second section, to the state default and the mechanism which are under discussion. Again, we have two questions. The first question, both questions please with a clear yes and no. First question, should state bankruptcy be feasible in the Eurozone? And I would like to start with Professor Franke.
No.
Yes.
Professor Janáček.
I am outsider, as I stressed, but I think yes.
I say yes also.
Okay. Second question, before we come to a statement. Does the euro area need a sovereign debt default mechanism? Again, Professor Franke.
Yes.
Yes.
Yes. Sure.
Yes, yes.
Agreement.
Okay.
Professor Franke, you kindly.
Okay, why did I argue against a state bankruptcy regime? Now, we have talked a lot about resolution procedures for SIFIs, and similar to SIFIs, we have systemically important countries in the Eurozone, so therefore, similar to SIFIs, we have to avoid a disorderly bankruptcy procedure for states, because that would destabilize financial markets. So therefore, we need a mechanism which triggers restructuring, a debt restructuring and structural reform mechanism in countries before they go into some state of bankruptcy. So therefore, who could trigger that? I think the Eurozone, Brussels could trigger it, perhaps the ECB could trigger it, perhaps also the country itself. So therefore, we have to have some mechanism to avoid bankruptcy, but to have some debt restructuring mechanism and some economic restructuring mechanism. Now, already the question was asked, what are we seeing when we look at the Greek interest rate now in the last issue? Now, if we rule out state default, then of course you have low interest rates. But then if this is more or less officially ruled out, then the Eurozone faces a severe hostage problem. Because an endangered state knows that the Eurozone will prohibit a default. And that of course gives very much power to such a state. The state could largely ignore conditions set by the Eurozone for funding support. Now that raises a governance question. How resolve the conflict between the Eurozone governance and national autonomy? Of course, we have a trade-off. We can say, okay, if we provide some financial support to a government, then this justifies restrictions on national autonomy. So in that sense, there may be one reason. But my guess is that currently more and more people feel that this rule by Brussels is not justified. And in particular, the story is that Brussels puts too much emphasis on austerity and too little on structural reforms and Keynesian economics. And this feeling erodes the political power of the European Union, and that means that the pressure on governments to listen to Brussels clearly declines. That then raises the question, is there a substitute for the Eurozone governance? Well, I think, of course, we always talk about investor control, investor markets. Now, the problem with investor control is currently the intervention of the ECB gives the impression that there will be no bail-in. But that, of course, is in some cases only viable if there is an indirect bailout. So we move from a direct bailout, which is prohibited already in Maastricht, to an indirect bailout. Now, and that, of course, explains also the low interest rate on Greek government bonds. So therefore, now the current situation doesn't allow for a reasonable control of investors. But my conclusion is that since the control of Brussels will be eroded more and more and leads to a postponement of necessary reforms in countries, that could actually undermine the solvency of some states more and more and force more and more indirect bailout. And this danger, I think, motivates a very strong need to re-establish investor control through some institutional framework, which is a restructuring mechanism, so that investors can somehow predict state probabilities, state default probabilities, and price them. That also would strengthen the national responsibility and autonomy and reduce the more or less undesired governance of Brussels. Thank you.
Now the question to you. Why do markets fail to price state default risk correctly? I mean, they've obviously put in a number, but why do markets fail to price state default risk correctly?
Yeah, that's the point, to market the price of default risk perfectly, correctly. In Latin America, it was much easier because bankruptcy was only for countries like Mexico, Brazil, Argentina, so it was much easier to deal with bankruptcy. But to deal with bankruptcy in the Eurozone is much far complicated. I know that. You need mechanism. You need mechanism that must be accepted by all the members of the Eurozone. So this makes things a little bit difficult. But this could not prevent the members of the European countries to bankrupt anyway. Because if they cannot afford to repay their debts, there is no other way out. I'm going to say the following. What solved our problems there in Latin America was the Brady program. I think we should try to adapt a kind of Brady program for the.
Before we come to that,
yeah.
Professor Janáček, do you agree with the analysis of Senior Gomes that Europe is different from Latin America, and therefore?
I think that the markets are assessing, let's say, the situation in rather correct way. I would like to remind you one thing. We are all congratulating ourselves that the Greece was 2 weeks ago or 3 weeks ago able to sell the sovereign bonds under 5% on the markets, and that's the difference. But I would like to remind that it's a big success. But I would like to remind you that 15 years ago, before the entry of the Greece in the European Monetary Union, the difference between the German bonds and Greek sovereign bonds was almost the same as it is now. Only the level are different. We have the very short memory. And we must assess not only, of course, the situation that Greece 2 years ago was unable to finance themselves at 15 or at 20. Now it is possible from time to time at 5. But we must also assess this difference, and this difference is, let's say, the assessing the long-term problem of sovereign debt of Greece. I think Greece, from my point of view, will be unable to finance themselves on the financial markets before 20.
Professor Janáček, again,
Fully.
what you raised, and I would like to pass on to Dr. Meyer. We all have in memory the pie chart of who was actually buying the Greek bonds, and we all know quite a number of so-called hedge fund, whatever the exact funds were, bought into them. Was that a risk-free lunch?
Pretty much so. I would just add to Professor Janáček's remark that back then the German and the Greek debt ratio were roughly similar. Now the Greek debt ratio is twice the German debt ratio, and it doesn't bother people because of this idea that there is now a political backstop created by the combination of ESM and ECB. And from that point of view, it's very rational to drive these bond yields spreads very low. So I think the markets are pricing it correctly. They make a bet, which I think is a reasonable one and probably a correct one, that since the middle of 2012, when Mrs. Merkel decided that Brexit was off the table and Mr. Draghi said that the euro would be maintained whatever it takes, that it is a fairly low risk, I wouldn't say riskless, a low risk proposition to engage in convergence trades again.
Okay. I mean, we have learned so far that the interconnectivity between banks and the financing of states has a certain knock-on effect, and that leads to the additional question, which we all know is currently under discussion, and some very high-profile people have raised that. Should banks back sovereign debt with equity? Again, as you know, a quick, short yes or no.
Yes.
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 Absolutely.
Thank you. That leads to another question. How much equity should be put under? And I don't want to get into this technical discussion, but the question, of course, then also it comes up, every member of the Eurozone the same percentage as underlying buffer, so to say? Professor Janáček, you maybe first. Short.
Of course, from a rational economic point of view, no. But from institutional point of view, yes. So that's the biggest problem. I must admit that I am in a very schizophrenic position. On the one time being professor of macroeconomics, and on the other time being central banker. So that as a central banker, I must admit it must be the same. As a theoretical economist, I must admit that no.
Which means it will lead to market arbitrage.
To market arbitrage. And the outcome of the arbitrage for me is very unclear. It's very exciting from theoretical point of view or analytical point of view, but from a realistic point of view, it's unclear what would be the outcome.
Same question to you, Professor Franke.
Well, of course, something is politically incorrect to say, as you mentioned it. So, you see, from portfolio management, from our own portfolio management, we all know if you buy stocks, you buy a well-diversified portfolio of stocks. Why not encourage banks, if they buy sovereign bonds, at least to buy a well-diversified portfolio of bonds? So, the regulator should encourage banks to buy well-diversified portfolios through appropriate risk measures.
Thank you. Let's turn to part 3, ECB competencies and the question about moral hazard. 2 questions. After each question, 2 of our panelists will give quick, short statements. First question, would the ECB, with the purchase of government bonds, exceed its competencies? And again, we make life easy and start from the right side or from the left side.
No.
No?
Mr. Chairman, as a central banker, I abstain the answer. You know that the good Mars among central bankers are not.
You have to fly back tonight.
I am flying very often to the ECB in this town. So I would like to be welcome next time as well. So.
A clear no?
My answer is yes.
Okay. Second question in this regard, does the ECB with bond purchases create a new moral hazard problem? Professor Franke, you stopped last, you were last, now you're the first to answer.
Yes, again.
Yes.
Yes?
Yes.
This time, yes.
This time, yes.
Mr. Gomes, that leads to your statement on would the ECB with the purchase of government bonds exceed its competencies?
Yeah. The point is the following. This controversy over the topic is justified, since there is a gray zone line between monetary policy and fiscal policy. The main goal of the purchase is not to finance the over-indebted members of the euro, but to ease financial conditions for all members by reducing the risk premium and improve the performance of the monetary policy. However, the government bond purchase could have fiscal costs. There are fiscal costs, but the positive effects of the programs are more important. The announcement that ECB would do whatever it took to save the Eurozone was the turning point. It allowed to reduce the sovereign bond costs. And also, I think that if the preconditions of the purchase are credible, buying bonds will help the monetary policy, allowing a better transmission of the ECB ultra-loose monetary policy, and therefore it doesn't exceed ECB's competence.
Thank you very much. Dr. Meyer, in this regard, does the ECB with bond purchases create a new moral hazard problem?
Yeah, I said it does. When you asked the question whether they would exceed their competences with this, then you did not say what's the purpose of the bond purchases. If the purpose of the bond purchases is open market policy, we all know that this is a standard tool of every central bank, and it's actually allowed under the statutes of the ECB. From that point, I understood the question as a general one. Yes, they can, and it's in the statutes. If you ask the question whether they would exceed their competences in buying bonds to fund governments, then the answer is, of course, yes, they would exceed the competences. Would they create moral hazard with it? Absolutely. We just have to look at the episode when the ECB bought Italian government bonds to ease tensions under an agreement with the Italian government, Mr. Berlusconi, that in return for the ECB support, they would implement structural reforms. The ECB bought the bonds, but the Italians did not implement any structural reforms. So this was moral hazard, almost like a textbook example. So I hope that it will go as a box in future textbooks, how that is created. Now, under the OMT program, the ECB says that they would reduce, if they would activate the program, they would reduce the spread that is due to the risk of the EMU falling apart, but not go on and reduce the spread that is due to the riskiness of individual government debt. I have no idea how you will be able to distinguish that. It's indistinguishable. They will go in and buy government debt if they activate the OMT and have the same effect that they had when they bought the Italian debt. So therefore, I think they will create moral hazard and they shouldn't do it.
As the current measures of the ECB have not really helped to increase inflation, and as we all know, debt reduction via inflation is one way out, or at least one of the tools. What other measures can you imagine, Professor Franke?
Well, I think the US policy of flooding markets cannot do very much, and I myself, I don't consider the inflation problem that much of a problem. You see, we have an inflation rate which is very much driven, first of all, by energy prices. And so if energy prices come down, I think we should be happy, and this will be a temporary phenomenon. I don't see that energy prices will come down gradually over the next 5 years. So therefore, I think this energy price story is a temporary story, and so we should be happy about it. And now, asking the question whether the ECB has to do something regarding the exchange rate, we know that if you want to affect the exchange rate, you can do it only in cooperation with the other central banks, and I doubt very much that the ECB can cooperate with the Federal Reserve or with the Japanese central bank to bring down the euro rate. So therefore, I think there is not much to be done, and I wouldn't worry so much about the inflation rate.
Sir Gomes, as a South American, you have experienced quite a bit the debt and inflation.
I don't believe that the ECB is going to create inflation. Unconventional monetary policies are needed today. And the point is the following. There is some inflation, obviously, assets inflation. ECB decided to buy sovereign bonds. Those bonds are having their price rising, and this is not good, I think, to some extent, because ECB, to some extent, buying bonds has some moral hazard, creates some moral hazard. Only austerity will avoid that. But if they buy bonds, they are changing the bond price risk. They are pre-pricing the risk incorrectly. This might create a bubble in the bond market, a rally in the bond market. You see what's happening now. Portuguese bonds, they are already in the market. Greek bonds are already in the market. But those countries are not in such a good shape to launch new bonds because their prices are rising. Is this fair? That's my question. But here in Europe, the inflation rate is under control. There is no impact on the inflation rate, but there is impact on the asset price inflation.
Professor Janáček,
I fully agree with...
hang on, no.
Of course.
If it's not inflation, what are the right measures? What's the right way out? As a central banker, you can pass on that question to Thomas Meyer, if you wish.
No. I must admit that in my country we are quite in another situation as in Eurozone countries. There is a lack of funds for granting credit in the first place to small and medium-sized enterprises. In my country, there is a lack of fund and very little demand for the credit, so that I must tell you that we are, let's say, small, medium country, and each night the Czech banks are parking around 300 billion Czech crowns. It means almost 12 billion euros of unspent funds. There is the lacking demand, so not the case, so that the rates are very so. For I don't know if the Fed program, let's say, to helicopter the money on the markets would be feasible in Europe. I very doubt, let's say, the project of negative interest rates. Denmark proved that this is not functioning. And I think in this case, the only diplomatic answer of the central banker would be to repeat Mario Draghi: we will use unconventional and conventional measures. So,
Dr. Meyer,
we must.
Dr. Meyer, in addition to what Professor Janáček told us.
It's an extremely difficult question, and I think what the ECB can do or must do, if you exclude debt restructuring, we have said that's no longer on. Yeah, we exclude exit of a country from EMU.
Yeah.
So if we put these constraints into our model, The only way forward is to keep inflation in the countries outside of Germany and near German neighbors below the level with which people are happy, and unemployment above the level with which people are happy. And in Germany, you have to get inflation above the level with which people are happy, so that everybody in EMU will completely unhappy with the situation for years to come. And then you have to hope that there is not enough political momentum to break up the system. This is the path forward.
If I may summarize for a second, we very fast we agreed, or we noticed and realized that gentlemen agree on that the crisis is not over. That's straightforward. Also, there's a clear agreement amongst the gentlemen that banks should back sovereign debt with equity. Also, yes, there should be a debt default mechanism. No, not specifics how this should be. And the last couple of minutes also again they provided us with the idea, with a clear view that the measures are the difficult thing to agree upon. ECB, the tools all central banks usually have, demonstrate that of course there are the pros and cons. And it seems to be uncertainty what the right measures are in terms of to lead to success, to lead to quick success. And Senor Gomes, you rightly pointed to the point that 5.5, 6 years after crisis, and you referred to South America of 20 years of austerity program, of healing the crisis, so to say. And you probably, hopefully, you have not led to the idea that we have another 15 years to go. I think we should be a little faster here. We should, of course, and I would like to ask the audience and introduce the audience at this point. There are certainly questions in the audience, and we are very happy, the gentlemen are very happy to take questions. Again, please be precise, short in your questions, and please also tell us whom you would like to address the question to. Please.
Herr Schorlemer, I'd like to address the governor of the central bank in Brazil. I was a little bit puzzled by the comparison of Mr. Mayer, the political dimension he referred to in his last statement. In South America, you are very much more experienced with debt crisis compared to Europe in the last 20, 30 years. Would you share the view, the rather skeptical political view of Mr. Mayer if it comes to the involvement of debt crisis and the political crisis?
Yes, here is, I think the debt issue is much more difficult than in Latin America because there is a political involvement. In Latin America, it took us 2 decades to solve the problem because we have some similarities with Europe. We borrowed abroad on currencies that we cannot print. We borrow dollars. Here, it has happened the same thing. Countries here borrowed abroad on currencies they cannot print. They borrow euros. So, how to solve this problem? In Latin America, it was easier to some extent because we had the Brady bonds. That was a kind of haircut for the bondholders. But at the same time, it was important for Latin America to come back to capital markets. Only after Brady bonds, this was possible. 20 years. Here in Europe, there are many countries, as I told you, Portugal, Greece, they are come back to the capital markets. There in Latin America, it took many years. Because that's the reason that I think the debt issue crisis is not over here now. It's going to take some time. Because why Portugal and Greece have come back to the capital markets? Because ECB bought their bonds. And this created a kind of rally in the bond market. But that's not good because Portugal and Greece have not made sacrifice yet to afford them to come back to the capital markets. That's the contradiction that I see between the euro debt crisis and the Latin America crisis. It took us many years to come back to the capital markets. Now, some countries have come back to the capital markets after 2 or 3 years, without making sacrifice yet. How to solve this issue?
Thank you. Additional questions from the audience? Yes, please.
I have a question to all of you. Do you think that Eurobonds could be a good solution to solve all these problems with credit spreads and so on?
Dr. Meyer, you would like to start?
It's a political poison pill. Eurobonds. It may be technically a neat way to bring the spreads down, but politically it poisons the whole situation as we are not ready for the mutualization of debt.
From my point of view, no.
Professor Franke?
No, I don't see it as any solution because this national governments have to do the job.
Yeah.
Europe can only be helping, but the main job has to be done by the national governments. And if you take the financial responsibility away from the national governments, of course, you take away the responsibility in every economic respect, and that can't work.
I agree with Professor. It's up to the national members of the euro to make sacrifice. Not it's up to the euro community to make sacrifice for the others.
Thank you. We still have time. Yes, please.
Herr von Schorlemer, when you opened or introduced the panel, you mentioned the nexus between government debt on the one hand and stability and banks on the other hand. If we look at the current set of rules, how convincing is that set of rules that we are facing, whether policymaker states really want to break that link? You mentioned the zero risk weighting for government bonds in the current Basel proposal. Liquidity rules is another aspect. One could argue, does it really reflect government debt? Another dimension, a different dimension is micro and macroprudential supervision being combined after the ECB rules. That makes me personally rather skeptical, but question for the panel, and it could be either the central banker, would be interesting to get your view, or someone independent like Professor Franke, whether we're really...
We can ask both parts, the academic and the central banking part to this question.
So I fully agree with you. Of course, from theoretical point of view, Basel III is solving this problem. You ought to assess the risk weight in the books of the bank, also for sovereign bonds, even for the bonds AAA. But, it is a big but, it is upon national discretion. And I must admit that we are at the same time central bank responsible for monetary policy and from the supervision of all financial institutions in my country. So I know that this problem will be solved very differently among all 28 EU member states. Stop. Full stop.
Well, see, from political economy, we know, of course, that if you are a bank in some country, then you are dependent primarily on that country, and you are also primarily dependent on the politics of that country, and therefore it's a very bold assumption that we can motivate banks not to buy sovereign bonds of their own government. So therefore, either you force the banks not to do that, that would be one very rough kind of rule, or you have to accept that there is this political economy argument, which of course gives a natural incentive to the banks to buy also bonds of their own governments. And as Professor Janáček has said, even here, I think since we see a growing national sovereignty movement again, we cannot force all these things upon the banks and on the politicians from Brussels. That wouldn't work.
So even if I can something, even we cannot force directly the Czech banks to buy the bonds of the Czech Ministry of Finance, of Czech governments. We can do it only indirectly, discussing with the banks how to assess the possible risk, let's say, of long-lasting recession of the Czech economy and so on, or some shocks and so on.
That's very interesting. So you can encourage your banks.
We can encourage, but we are not doing it so to the moment. But we have the tools. We have the tools. It's the microprudential tools you have mentioned. So that it's a very, I think it's a very powerful instrument if you have under one roof supervision, regulation, and monetary policy. If you have several regulators, as in other Central European countries is the case, it's much more difficult.
One very last question from the audience before we turn to the final round. Yes, please.
Thank you. Can I ask my former colleague Tom Meyer something? I was slightly puzzled. Why do you think it is a good thing that the European Central Bank can intervene via bond purchases in the long end of the market? Why don't you leave that to the market to decide what the long-term situation will be, and then define by that, by their market reaction, what the interest rate will be? Should really a central bank influence more or less directly long-term interest rates?
Can I answer to this
Please.
directly? It should, of course, not. Remember that the question was, would the ECB exceed its competences if it bought government bonds? And the answer is, of course, not. Because classical open market policy, to which the ECB is entitled according to its statutes, envisages that. They can buy bonds. They do not have only engage in refunding operations with the banks. They can also buy directly bond. It's in the statutes. From that point of view, I don't see that they would exceed their competences. If they use that passage in the statutes to support governments or to manipulate the yield curve, I would say they exceed their competence and shouldn't do it. That's a big difference, right? But one cannot deny that they have the right to do it.
So we finally come to the final round, which means I start a sentence and you please complete that phrase. And again, I start with a phrase which I will not ask you. You are for the second one, Professor Franke. Experiences from national bankruptcies in Latin America teach us that.
Let me just say, I'm not happy to complete the sentence, but to say, I think the experience from the US is very interesting. There we have many states under the same currency, and we haven't seen any state bankruptcy after the 1840s. We should ask ourselves, why didn't we see that in the US, and what is the mechanism driving that?
Professor Janáček on.
I fully agree with Professor Franke. Yeah, it's forbidden in the Constitution, American. So,
Second question, it's the second phrase. The next episode in the sovereign debt crisis is?
Monetization of public debt.
I agree with him. The next challenge should be the monetization of the public debt. And also, the question is the following. That's the challenge. The central banks, they are manipulating the yield curve. That's the point. How to live with that without the consequence. That's the most important question. Here, ECB is manipulating the yield curve. United States, the Federal Reserve is also manipulating the yield curve. How the market is going to react to that.
Before summarizing up, will we meet in 5 years again and discuss the same topics, the same questions? Professor Franke.
Well, the next episode in the sovereign debt crisis is a revival of national sovereignty at the expense of European governance, and that means that Europe has to find a new way how to manage the integration of the European Union.
Unfortunately, we are always prepared. We are preparing for the old wars. We are not prepared for the new. We cannot be prepared. Each new financial crisis is slightly different from the past financial crisis, and I think that we must, and now I'm talking about the Europe of 28 or the common European economic area, Europe 30-31. We must try to find a new ways how to cooperate, how to solve the problems during the crisis.
You basically connect politics and macroeconomic
Of course.
factors.
Central banks, of course.
We cannot just have a distinct discussion on, we can discuss individual strings, but
you cannot have the precise plan.
yeah. Mr. Gomes, what do you think? Same?
I think the same. I think the same.
Dr.
Well,
Meyer?
I would say, since you gave us a 5-year horizon, that's of course a risky forecast to make, but I would say within these 5-year horizon, we shall be discussing a political crisis of the European Union, brought about by disagreements and conflicts between the strong countries and the weak countries in EMU, and between the ins and the outs of the euro.
The good thing is I will not remind you in 5 years' time. It will be all on the net anyway. Good agreement, some disagreement with the right tools, or when to set the right tone for the right tools. I think I have not overpromised when I said the experienced and very in-depth knowledgeable gentlemen contributed to the various questions we have and to this very interesting discussion. And I would like to thank you very, very much for being here, for being on the panel, and contributing with your remarks, with your statements. Thank you very much, and thank you very much to the audience as well.
Thank you for a very, very nice and effective